Fundsupermart.com.
News surrounding the Eurozone debt crisis has generally died down over the last few months. How do you expect the situation to play out in 2013?
Well, the recent developments in the Eurozone are very interesting because when you try to analyze the situation in the Eurozone and why the debt crisis was such an issue, you will inevitably find two big reasons. The first one is a problem of growth. Basically, if you want to adjust your financial position and reduce the load of debt and reach fiscal consolidation, you need growth at some stage. And the European economy is facing that problem for a long time. But this is the structural issue that we will continue to see going forward. Another factor which was very important in the development of the crisis is the governance issue. Each time the Eurozone had to face a financial crisis, it was like if European leaders and policymakers had to reinvent the wheel each time, because there wasn't any institutional framework to deal with market tensions, especially on the bond market. Last year, the ECB came up to the market with a very interesting new scheme, the outright monetary transaction scheme, so a massive, unlimited or potentially unlimited bond buying program. And this was a game changer because for the first time we started to see the emergence of an institutional scheme that can address in a convincing way tensions on the bond market. And this is something that the bond market has clearly reacted to, and since the announcement of this OMT program, we have seen yields in the Eurozone declining, especially in Italy and Spain. So as we enter into 2013, the outlook is a lot more promising than in 2012 in terms of risk management. Now, the tail risk of seeing a breakup of the Eurozone is extremely limited thanks to the decision of the European Central Bank. It doesn't mean that it's the end of the problem of the Eurozone because we are still facing this GDP issue. But clearly, the outlook has improved for the Eurozone. And I think asset markets for the Eurozone will tend to react to this new situation. We have seen that in the last quarter of last year with a very strong performance in the peripheral countries. And it's likely to continue in the course of the year. But bear in mind that growth will remain extremely low in the Eurozone for the year, and this will continue to have an impact on market sentiment. So we have a slightly positive bias towards risky assets in the Eurozone, but with a lot of caution.
Within equity markets, where do you see the greatest opportunities?
We believe that the parts of the world showing the best economic performance will tend to outperform in 2013. And on that regard, emerging Asia is clearly the place where investors have to be. Now, having said that, it's important also to distinguish the situation on the equity market and on the bond market. The outlook for the equity market seems to be more promising, like at the global level, simply on the fact that valuations are attractive and GDP growth will tend to accelerate in the course of the year. So that's a very favorable environment for equities. Now, looking at bonds, the situation is slightly different. Asia is probably the part of the world where credit spreads have compressed the most. And we are now not too far from the lowest levels we saw before the onset of the financial crisis. So the potential for further credit spread compression still exists, but it's more limited than at the beginning of last year. So we remain fairly positive on emerging Asia bonds, but the cautious tone I mentioned before is clearly something that investors have to bear in mind for this year with emerging market debt. The fact that investors need to be very selective, and at HSBC Global Asset Management, we tend to prefer a very precise segment of the market, which is the BB, BBB segment of the market, because we are at the juncture between investment grade and high yield, and this part of the market offers the best compromise between risk profile and yield. So if investors are disciplined enough to really focus on this segment of the market, the prospect for 2013 is still positive, but clearly investors should not expect the same kind of performance as in 2012, simply because the entry point this year is much higher, and the potential for positive return is limited by this fact.